Hey everybody, welcome back. My name is Yasin Nizami and I make these videos to educate my audience about the real estate market in Canada, particularly in the GTA market, some macroeconomic factors, some geopolitical situation, and some investing strategies as well. If you're interested in any of these topics, consider subscribe. And in this video, I'm going to cover the recent news. Actually, a report publication came out from the National Bank of Canada where they're explaining how the housing affordability has gone worst and going back to the 1980s where we saw the worst decline in the affordability level. So I'm going to jump right into this article from Stories where they're highlighting the news, the report published by the National Bank of Canada. And what they're saying is basically the way they calculate housing affordability is basically based upon the monthly mortgage payments. And what we are seeing right now is the rising interest rate is making the monthly payments pretty much unaffordable across the board. And because the rates are aggressively going up, we have seen 400 basis point rate hikes in the last 9 months. We haven't seen that aggressive rate hike, and we haven't seen the level of terminal rate since 2008, when we had the global financial crisis. So when we look into this article, they're seeing that what we saw back in 1980s, from 1986 to 1989, there was a consecutive 6 or 7, actually 11 quarters of declining housing affordability. And what it meant is the mortgage payment, the monthly mortgage payment, is now representing 67% of a household income. So just imagine if your household income, that 67% of that goes into mortgage, what you have left to spend on your food and the clothing, your kids' activities, your dining out, and your vacation. You don't have enough left to spend on any of those activities, and this will lead into reduction in the consumer spending, which will definitely reduce the aggregate demand and hence will be reflected in the CPI, i.e. inflation, going forward. So according to them, because of this condition, this scenario, the housing will further slow down in terms of pricing, and we will see another 15% decline from here in 2023. And they just gave us a data where they're saying that hey, in the GTA market, the average house price, a semi-detached or single basically family home, is around 1.3 million. And in order to buy that property, you gotta have up to minimum 270 plus K annual income, and you need almost 361 months worth of savings in order to put down a deposit and meet your closing cost. That's how ridiculous the affordability is. And if you buy a condo, which is average priced as 738K, which will require 170 plus annual income and 65 months worth of saving. So that will tell you exactly, the affordability is off the charts right now. And if you look at the Vancouver market, which is the priciest and the expensive market in Canada, the average single family home is $1.7 million. In order to buy that, you gotta have at least 347K annual income and up to 459 months of savings left aside in order to close down the sale. And when we look at the condo, which is priced at I think they haven't mentioned the price, but the condo requires 172K worth of minimum annual income and up to 64 months of saving required in order to meet your closing cost and deposit. So that tells you where we are headed with regards to affordability. And when we jump into the housing report from National Bank of Canada, this graph actually shows you how the affordability has deteriorated over time, and now we are going back to 1980s. And you know what happened in 1980s? The interest rate were almost at 18%. Even though the interest rate is much lower than 80s now, our debt level is so high, the monthly mortgage payment is almost same as if it was a $300,000 property with an 18% mortgage interest rate. So that's how the situation is deteriorating. And from here, I think things will have to be controlled either way, by a government intervention or otherwise, this will become a unaffordable balloon which will burst eventually and will take down the entire country's economy. The other thing I wanted to mention is next week Bank of Canada is going to raise another rate hike, possibly 25% or 50 basis point. And the expectation is that this will be the last one for this year or the entire rate hike cycle, and then they will take a pause. And the reason is we are seeing the damage is already being done. We're seeing the tech layoffs, pretty much every tech company. We're seeing the mortgage companies are laying off people. We're seeing the lawyers who are reporting that they used to do 40 deals a month, now they're doing 0 deals a month. So that reduction in the volume of sales is quite concerning. And one of the reasons is we don't have enough inventory, and the sellers are digging their heels in terms of the price depreciation. They're not selling if they're not getting enough price. The people who were only selling just because they had to sell are pretty much gone. Like, this was the time back in like June, July timeframe where people were stuck in the transaction, but now that period is gone. So the sellers are not in a desperate position anymore. So if they're not getting enough dollars, they're not selling, they're sitting on it, which means not enough options for the buyers. But there are still buyers who are looking for a property just to live. There is no investors anymore, but the genuine buyers are still there. And that's why the market is still very tight. So even if they raise 25 basis point, it is still the highest rate since 2008 global financial crisis. And what we have seen in the last week video, I covered that trigger rate has been executed pretty much across all the variable rate mortgage holders who have taken mortgages in the last 2 years, which means pretty much all of those guys are paying interest only, because the monthly payment is not covering the principal amount of it, which is going to be a shocker when they go for a renewal next time, because the principal will still be there as it is, and they have been only paying the interest on that. Bank of Canada's Governor Tiff Macklem is saying that the low unemployment is the cause of inflation. Like, you can't make this up. Inflation is not because of unemployment, guys. I don't know what is he smoking. The other thing I wanted to mention is because of the uncertainty in the market, recession fears, the bond yield, 5-year Canada bond yield, has gone down from its peak. We saw it was peaking around 375, and now from that onwards it happened back in September, and since then it is declining because of the recession fears. And as a result of that, some lenders have reduced their fixed mortgage rate as well, because the fixed mortgage rate, it moves with the bond market. If the bond yield goes down, then the fixed mortgage rate will likely to come down as well. And if we don't see any big black swan type event next year, and the market moves like that, which means recession is going to be there, then the bond yield will further decline, which will likely bring the fixed mortgage rate close to 4 or 4.25 as well. And this is when the people will lock into the fixed mortgage rate, because the variable rate is above 5% right now, and that is tied to the Bank of Canada overnight rate. So that's not going to come down anytime soon, guys. Maybe next year in the summer, but it depends on the inflation rate target as well. So that's all I have for this week. Let me know what you think. If you have any questions, comments, put them in the comment section below, and let me know what's happening in your market and what you want me to cover next time, because I always look for feedback and I always value your feedback as well. So please give your feedback in the comment section, and I'll see you in my next video. Take care.